Good day. We are Gretchen and Germaine, currently third-year students at CPUT. This presentation is for our Law of Contracts subject, and it will be based on the National Credit Act.
Angelique Simmons has successfully established a company called Payday Loans. She has also been approved by the National Credit Regulator as a registered credit provider. We will be advising her on drafting a credit agreement that complies with the relevant provisions of the National Credit Act. A credit agreement, it might sound formal, maybe a little intimidating, but don't worry, it's not as complex as it seems. Essentially, it's just an agreement between you and a lender. You're borrowing money and they're providing it. It's a mutual understanding that ensures both parties know what to expect. The agreement lays out all the details. This includes the amount you're borrowing, the interest rate, and the repayment schedule. It also tells you when you need to pay it back. The repayment schedule is clearly outlined so you can plan your finances accordingly. And of course, it details how much it will cost you in interest and fees. Understanding these costs is essential to avoid any surprises down the road. It makes sure everyone is on the same page. Both you and the lender have a clear understanding of the terms and conditions. This protects both you and the lender. It ensures that the lender gets their money back and that you know exactly what you're agreeing to. Credit agreements can be as simple as a one-page document. These are usually for smaller loans or straightforward credit arrangements. Sometimes they are much longer. More complex loans or credit arrangements might require detailed documentation. It all depends on the type of credit, whether it's a mortgage, a car loan, or a credit card. Each type of credit has its own set of terms and conditions. It also depends on the lender. Different financial institutions have different requirements and terms, so it's important to compare and understand them. In South Africa, we have the National Credit Act, or NCA. This law was created to promote a fair and transparent credit market. It does this by setting out clear rules and guidelines for credit providers. The NCA covers a wide range of credit transactions. This includes everything from personal loans to credit cards and even store accounts. It mandates that all credit agreements must be in writing. They must be in plain language. This ensures you understand the terms before you commit. For credit providers, complying with the NCA is not optional. It's a legal requirement that must be followed. Non-compliance can lead to serious consequences. These include hefty fines, reputational damage, and even the loss of your operating license, which can be devastating. But beyond the legal implications, complying with the NCA is simply good business practice. It shows your customers that you are committed to ethical lending and transparency. This builds trust and fosters stronger customer relationships over time. Remember, a satisfied customer is more likely to return for future business. They are also more likely to refer you to their friends and family members. Compliance with the NCA is a win-win for everyone involved, ensuring mutual success. Section 4. Essential elements of a compliant credit agreement. So, what makes a credit agreement NCA compliant? There are several key elements that must be present. These elements are non-negotiable. They are the foundation of a fair and transparent credit agreement. Firstly, the agreement must clearly identify both the credit provider and the consumer. This includes full names, contact details, and any other relevant identification. Secondly, the agreement must specify the type of credit being provided. Is it a personal loan, a credit card facility, a store account? This must be explicitly stated. Thirdly, the total cost of credit must be disclosed up front. This includes the principal amount borrowed, the interest rate, any fees or charges, and the total repayment amount. Section 5. Navigating critical clauses, interest rates, repayments, and consumer rights. This section is crucial for anyone entering into a credit agreement as it outlines the fundamental aspects that protect both the lender and the borrower. Now let's delve into some of the critical clauses that require careful attention to ensure compliance with the NCA. Understanding these clauses can help you avoid potential pitfalls and ensure that your credit agreement is fair and transparent. Interest rates. The NCA sets limits on the interest rates that credit providers can charge. These limits are designed to prevent exorbitant rates that could lead to unmanageable debt for consumers. These limits vary depending on the type of credit. For instance, the interest rate on a personal loan may differ from that on a mortgage or a credit card. It's essential to know the specific limits applicable to your type of credit. Your agreement must clearly state the interest rate being charged. This transparency allows you to compare different credit offers and choose the one that best suits your financial situation. This rate cannot exceed the prescribed limits. If you find that the rate in your agreement is higher than the legal limit, you have the right to challenge it. Repayment terms. The agreement must outline the repayment terms in detail. This includes not just the total repayment amount, but also the structure of the repayments. This includes the repayment period, which is the total duration over which you will repay the loan. Knowing this period helps you plan your finances better. The frequency of repayments, like monthly or weekly. The frequency can significantly impact your budgeting, so it's crucial to choose a schedule that aligns with your income flow and the amount of each repayment. This amount should be manageable within your monthly budget to avoid financial strain. Consumer rights. The NCA grants consumers certain rights. These rights are designed to protect you from unfair practices and ensure that you are fully informed about your credit agreement. These rights must be clearly explained in the agreement. If any of these rights are not mentioned, you should ask for clarification before signing. These rights include the right to information, which means you have the right to receive all the necessary details about your credit agreement in a clear and understandable manner. The right to prepay the loan, allowing you to pay off your loan earlier than scheduled without facing any penalties. This can save you a significant amount in interest, and the right to access a credit bureau. This right ensures that you can check your credit report for accuracy and dispute any errors that may affect your credit score. Understanding and exercising these rights can empower you to make informed financial decisions. Section 6. Clear and concise examples of NCA compliant clauses. In this section, we will delve into specific examples of clauses that adhere to the guidelines set forth by the National Credit Act. These examples will help you understand how to draft clauses that are both clear and compliant. Let's look at some examples of how these clauses can be worded to ensure clarity and compliance, ensuring that both the lender and the borrower are fully aware of their rights and obligations. Properly worded clauses not only protect the interests of both parties, but also foster a transparent and trustworthy lending environment. Interest rate clause. The interest rate applicable to this loan is 15% per annum, calculated daily on the outstanding balance. This means that the interest will be computed on a daily basis, ensuring that you are only charged for the actual number of days the loan is outstanding. This method of calculation is fair and transparent, providing a clear understanding of how interest is accrued. This rate is within the limits prescribed by the National Credit Act. The Act sets maximum interest rates to protect consumers from exorbitant charges, ensuring that the lending process remains fair and equitable. By adhering to these limits, lenders demonstrate their commitment to ethical lending practices. Repayment term clause. You agree to repay the loan in equal monthly installments over a period of 24 months, which provides a structured and manageable repayment plan. This clause ensures that the borrower is aware of the exact amount they need to pay each month, helping them to budget effectively and avoid any financial strain. Commencing on the first day of the month following the date of disbursement. This gives the borrower a clear start date for their repayments, allowing them to plan their finances accordingly. It also ensures that there is no confusion about when the first payment is due, promoting a smooth repayment process. Consumer rights clause. You have the right to prepay this loan in part or in full at any time without penalty. This clause empowers the borrower by giving them the flexibility to pay off their loan early if they are able to do so without incurring any additional charges. It encourages responsible borrowing and repayment behavior. You also have the right to access your credit report from a registered credit bureau. This ensures that you can stay informed about your credit status and take any necessary steps to maintain or improve your credit score. Regular access to your credit report is a key aspect of financial health and responsibility. Section 7. Challenges in drafting compliant credit agreements. Drafting credit agreements that are fully compliant with the NCA can be complex. There are potential pitfalls to be aware of. One challenge is staying up to date with the ever-evolving regulatory landscape. The NCA is not a static document, it is subject to amendments and updates. Another challenge is ensuring that the language used in the agreement is clear, concise, and easily understood by the average consumer. Legal jargon should be avoided. Furthermore, ensuring that all the necessary clauses are included and correctly worded can be a daunting task, especially for those who are not legal professionals.